Good morning. Thank God it's Friday. Welcome to today's episode of Morning Well. Three things that we will talk about. US trade deficit widest in 12 years, call option impact, and non-farm payroll day and what to expect. The US stocks fell sharply yesterday with their worst showing since June, driven by a broad decline in many of the technology companies that have led the market higher in the recent months. Tech-heavy Nasdaq dropped about 5%. That's the biggest one-day percentage decline since June 11, in a reversal of a rally that has taken it and the S&P 500 to new highs. S&P 500 was down 3.5%. All the 11 sectors were showing losses. Dow Jones fell 2.8%, interrupting a rally that sent the Dow Industrials above 29,000 for the first time since February a day earlier. Big technology companies led the sell-off, which accelerated in late trading before pulling back. Facebook was down about 3.8%. Tesla was down another 9%. Apple lost about 8%, a drop mitigated by its August stock split. Still, Apple lost about 179 billion in market capitalization on one day. That's the largest one-day loss for a US listed company on record. Now, here's the thing. The drop was larger than the individual market capitalization of 470 of the 500 companies in the S&P 500. Some companies tied to the reopening of the economy, including cruise liners, airliners, and some retailers, recorded some gains. Carnival was up about 5.2%. United Airlines and Ralph Lauren also were up about 1.4 and 3.6%. On the economic front, fresh data showed seasonally adjusted 881K Americans applied for unemployment benefits for the first time through the week ended 29th of August. Unemployment claims have also continued to edge lower but remain near historic highs, signaling continued layoffs as coronavirus has hampered economic recovery. US trade deficit swelled to the widest in 12 years in July. The overall gap of goods and services expanded to about 63.6 billion from a revised 53.5 billion in June. The import side pretty much bounced back, but the exports has not, and which has led to this gap. So imports grew by about 11% in July to about 231.67 billion, as Americans bought more foreign-made vehicles, industrial supplies, capital goods, and consumer products like cell phones and furniture. That pushed the monthly goods deficit to the widest level on record. While the US runs a deficit in goods, it runs a surplus in services. Now, that surplus in services such as tourism, medical care, and higher education shrank in July to the lowest level since August 2012, as many foreign visitors obviously stayed at home due to the pandemic and the international borders closed. Restrictions on travel, many of which remain in place, also make it difficult for exporters to find new foreign customers, which has also been a drag on the export numbers. Broadcom gave a bullish forecast boosted by spending on data centers and a predicted rebound in smartphone chip shipments. This was an interesting observation from Saxo Bank, which I wanted to share. In the past few weeks, we have seen an increased number of call options that have been bought, both on the indexes, but also on individual stocks. So uptick in market volatility could be also due to a large number of call options, which confer the right to buy shares on, stocks like Apple and Tesla. On the other hand, market makers are forced to take the other side of such trades, that is buying the underlying stocks to hedge their positions. US stock options trading has been driven by individual investors as per the head of equity strategy at Saxo Bank. So if shares in a stock fall enough, market makers will unwind their shares, causing a sharp sell-off. So it will, it'll be a chain reaction that gets triggered. On the FX side, the US dollar sold off against the Japanese yen and the Swiss franc, but traded higher against all high beta currencies with the exception of euro. Today is non-farm payroll day. Bloomberg Economics projects a net hiring increase of 500K in August. The median consensus estimate is for a rise of about 3.35 million, with the forecast range spanning from negative 100K to 2.4 million. That's the range that we are kind of, expecting today. The level of employment will remain significantly below the pre-crisis peak after incorporating the estimated 500k increase in August and the 3.5 million cumulative rebound that we have seen in May, June and July. But even after that, the economy would have only recovered 44% of more than 22 million jobs that were lost over March and April period. The unemployment rate is expected to improve, but average hourly earnings growth may stagnate is what we are expecting. That's the update. Stay safe and healthy. Have a lovely weekend and speak to you on Monday.